Good morning, good afternoon, or good evening, depending on where you're dialing in from today. We're just waiting on a few people to come in to the call. First of all, welcome. Thank you very much for your time. We promise that what we're going to talk about today is very much going to be in line with people's decision-making process over the next 3, 6, 9, 12, 24 months, because there's a lot to cover off on. If you consider where we are in the grand scheme of things at the moment, we're dealing with an invasion of Ukraine, record inflation, especially in Australia, 32-year high just recently this week, combined with COVID, combined with many other things, and we've got China rattling the sabre as well too. So today's briefing is all about just giving you guys the tools, the information, and the arsenal in order to make fully informed decisions. Just as a bit of a side, joined by my colleagues and mates, James Ridley, who's the Managing Director for the Asia Pacific region for Atlas Wealth Management, and Jeremy Harper, who's the Managing Director for Atlas Mortgages, who helps our clients secure Australian home loans around the world, and also to refinancing as well, which is a big thing that Jeremy's going to talk about today, because interest rates are certainly a very topical piece. And while we thought they were going to die down with last month's 25 bip rate rise, given this week's inflation data, it looks to be game on again. So I think we've got most of the people online now. So to give you an idea, we've got almost or just over 500 people dialing into this and tomorrow's webinar. So I haven't done a country count, but let's just say that we are going to the four corners of the world today. So without further ado, can I just get everyone to make some comments and just confirm that they can see the presentation on the screen, please? Yep, fantastic. Thanks, Paul. And just a bit of housekeeping as well. We will be running a Q&A session at the end. So as we're talking, feel free to type your questions into the question box, and then we'll do that Q&A at the end and run through and obviously cover off on any of the details with respect to questions, what we can answer. Obviously, the information today is general advice. It's not to be treated as personal advice. If you do have to obtain personal advice, please make sure you reach out to a licensed professional, someone like Atlas, of course. So without further ado, let's get the show on the road. So no presentation by a professional will be replete without having some disclaimers. So pretty much what those 4 paragraphs there say is you should treat this as educational purposes only, informational purposes only, and if you do need to get advice, please speak to a professional. This is a bit of one for me here in the DIFC. We're the only Australian firm that is dual licensed in the United Arab Emirates, and we are licensed both with the Australian Securities Investment Commission as well as the Dubai Financial Services Authority. Something we're very proud of. What that means for people like yourself on the call, it means that you are protected, which is a word that is not often shared in this region. So something we're very proud to offer Australian expats. Who is Atlas Wealth Management? Essentially, we're the leading provider of Australian expat tax financial advice, and we won many awards, both domestically and internationally. Very proud of that. We do bat way above our average. We do go against the likes of HSBC and those sort of firms when it comes to these awards. We're classified as a tax financial advisor with a tax practitioners board in Australia, which essentially means we can provide tax advice pertaining to the management of your finances and how that pertains to your jurisdiction. We have the privilege and the pleasure of working with clients in over 43 countries. That number is always changing because our clients keep moving, but 43 seems to be the most stable number to share. And all of our financial planners are degree qualified and have many post-nominal certifications as well. So when you are speaking to an Atlas financial planner, we do have the qualifications behind us. We weren't selling used cars or carpets the week before we were doing these calls. Services that we provide to our clients, tax financial advice obviously, asset management, financial planning, pre-departure reviews for those who are about to become expats, repatriation reviews for those who are about to go back to Australia, and as well as obviously Australian mortgages that Jeremy will be covering off on. So 3 good-looking heads for radio there, myself, James and Jeremy. We all have our skill sets, we all have our specialisations, And that's what makes Atlas very unique. You know, the conversations that I'll have with clients in the Middle East will be very different to conversations that James has with clients in the United States. So it's important that people understand that your jurisdiction, your residency, can have a varying degree of complexity and also difference between other expats. Even though we're all Australians, it is very different on a case-by-case basis. So running through today, we're going to talk about the federal budget and try not to make you yawn through that. Then Jeremy's going to run through the Australian lending landscape, and then at the end I'll be covering off on the economy as well as the Australian property, currency and equity market updates. So we'll run through that with you guys. So without further ado, I'll hand it over to James, who can run through on the budget and the excitement that entailed on Tuesday night.
Thank you, Brett, and thanks for that warm-up. Yeah, I mean, as we all know, the budget, it was handed down only 2 nights ago now, and I guess for expats, not too much in there just yet, so we're going to move through a bit of a summary, and as we move through today's summary, I guess a lot of us on here to learn a bit more, especially about what way the tax residency rules kind of sat. So I'll jump into that very shortly, but generally speaking, when we look at the budget, the government, it's referred to the current budget as a solid, sensible and suitable, especially for the times, with a significant focus trying to address the cost of living pressures. It's not a budget loaded with a lot of cash handouts, tax cuts, those sort of things. Definitely trying to address the cost of living pressures facing households. It delivers on the expectations that the Treasurer laid out, especially in the couple of days leading up to the big day. Election commitments that were fulfilled, revenue was upgraded owing to higher than expected commodity prices and a stronger nominal economy. Many of the announcements were more focused on addressing structural factors in the economy. Ultimately, they aimed at reducing inflationary costs and pressures right now, especially coupled with the fact that interest rates are on the rise. If we look at economic growth forecasts, it has slowed right down, and they're predicting next year it will slow down to roughly 1.5%. Unemployment rate right now very low, which we'll go into shortly, but expected to increase to 4.5% as that demand's curbs, and then inflation. It's expected to stay higher for longer and not return to the RBA's target band until 2024-2025. Next slide, Brett. Yep, great. So what we're looking at on this slide is, I guess, net debt as a comparison of GDP or as a percentage of GDP. I guess when we look at the actual key figures in dollar terms, it is a very sobering number. When we look at the net debt of Australia, it's just over, or just under, sorry, 300 billion, but not all that bad compared to the rest of the world. And I'll give you some comparisons soon. Right now, when we look at our run up to the end of June 2023, it's expected that net debt as a percentage of GDP will be about 23%. This is actually a lot lower than last budget that we had. They expected that we're getting up to 31.1%. So that's really good. When we look at, I suppose, some of our neighbouring countries that we're great mates with, the UK, the US, to put things in perspective, their net debt as a percent of GDP is 137%. And the UK is 95%. So the fact that we're only staring at 23%, that's actually really good. So that's really good for our economy. I guess, yep, compared to other countries, we don't really have much debt, and it's very manageable. I guess to try and put it in perspective, it's like you own a house that's worth $1 million, and your mortgage on that house is $230,000. So your loan to value ratio is only 23%. In that analogy, the house is essentially the economy. So we're in pretty good shape at the moment. Next slide, Brett. As we move into it and look at the beneficiaries, it delivers on cheaper childcare, more paid parental leave, better access to healthcare, cheaper medicines, a better standard of aged care, free TAFE in more university places. Free university, that would be nice, wouldn't it? Cheaper and cleaner energy, more affordable housing, and a future made in Australia. When we look at the previous budget, it mainly focused on some little offsets there. Some Social Security recipients received a bit of a cash boost. We also had the introduction of that 6-month fuel excise. Now that's ended. Fuel prices have come down as well since that sort of was implemented. Next slide, Brett, please. budget forecast on GDP. So we would say right now the government's measures or figures are always a bit slightly conservative around these numbers. At the moment, there are record numbers or amounts of cash in savings accounts and offset accounts around Australia, which still means we have a good amount of capacity. Because we still have a good amount of capacity, that's good for our economy, but I guess we'll have to see what plays out, especially over the next 12 months, because we've seen a quick reflection there of the difference between forecasting and what actually happens. When we look at the pre-election economic and fiscal outlook figures, they were thinking that GDP growth for 2022 was going to be 1.5%, but the actual outcome was 3.9%. Global growth, which isn't on your screen, that's forecasted to be 2.75% in the current Australian financial year. And I just want to make mention of the 2.75% because at the moment, our economy, when we look at the slides, we're on track to outperform globally. For the 2023 year, we can see there 3.25%. 2023, 2024, expected to slow right down 1.5%, mainly due to weaker global outlook, high inflation and cost of living pressures, as well as higher interest rates, which obviously curb demand. Next slide, please. Inflation. So when we look at inflation, I suppose inflation forecasts, they are going to be more persistent than PFO. PFO just stands for pre-election economic and fiscal outlook. It's throughout, I suppose, the budget papers that were released. The war in Ukraine, it's led to a spike in many key global commodities and further fueled the inflation fire. Global supply chain disruptions continue to have an impact. Global factors have been the main contributors of inflation. Right now, they're starting to predict that mainly now domestic factors are probably going to be the ones that start to grow, that cause the inflation, I suppose, impact in Australia. Right now, the economy, it is at full capacity, which is good, record low unemployment rates, which is outstanding. But they reckon domestically are now going to be the drivers for inflation over the next 12 to 24 months. I want to take note of the 2022 inflation figure, so 7.75%. That's where we're at right this second. That's real. 5.75% for 2023, the prediction. Just take note of those two key data points, 7.75 and 5.75, because I just want to refer to them on the next slide. So we'll move on to wage growth onto the next slide. So wages. I think it's a well-known fact that we've had terrible wage growth, especially over the last 10 to 15 years compared to the UK, compared to the US, sort of our major partners. When we look at, I suppose, inflation, there's 7.75 for current year, and then again 5.75 for the next financial year, or the financial year we're in right now. When we focus on the difference between the two, we can see here that there is a real delta or real difference. Wage growth 2.6%, but inflation 7.75%. Even if we're getting a pay bump in Australia, we're still probably going backwards, to be honest. It's going to be a similar figure for 2023. I suppose when we look at the RBA and the hard task it's had with interest rate movements, there's always a bit of a lag effect as well, 2 to 3 months, and that feeding into the economy and hitting our pockets. So it is going to be an interesting task for the RBA, especially over the next 6 months, given that wage growth hasn't really caught up. It's getting better, but inflation is still quite high. We'll now move through some key takeaways for expats as well. On to the next slide. So key takeaways for expats. Again, most or a lot of individuals on today's webinar, they will be heavily interested in the residency rules. Looking at the time we're capturing a lot of the UK, we're capturing a lot of the Middle East. With the current rules that they propose to update that they announced last financial year, we're still in a holding pattern, and I feel like that's always our perpetual existence when we're waiting on the Australian government. And right now, it's still based on the Board of Taxation's report with those proposals. They have not given us an update on that just yet. However, we do know Jim Chalmers said very recently, only in the last month, that the government's looking at the day count, and we believe that means he's looking at the 45-day factor test. However, recently, as of this month, the ATO has consolidated a lot of private rulings on residency, and it's going to essentially form the tool that they'll use going forward to make residency decisions until the new rules come through. So I'm actually going to deep dive a little bit into that in the coming slides. Other things that come away from the budget, well, as of 1 July, we know the removal of the work test for making super contributions from those aged 67 to 74 for non-concessional contributions has been put through, receive royal assent, which is great. The work test for claiming personal tax deductions, that still exists, unfortunately, but the increase in being able to contribute to super is great for returning expats that want to squash and shoehorn as much as they can into super. We know that that's always a bit of a problem when we're returning and trying to squash everything back into our main retirement asset. Moving on to the next slide. Further takeaways, so 1 July, they're extending the ability to bring forward 2 years worth of non-concessional contributions from age 67 to 74. That's great. The downsize of contribution. Not many expats will probably have been aware of this contribution, but they're reducing this down to 55. It definitely allows additional funds to be placed into the superannuation environment for retirement. Expats can still use this downsize of contribution on the assumption that they might have sold their former main residence in Australia as an ordinary Australian tax resident. If you're getting the ability to use either the full MRE or the partial main residence exemption, you can actually shoehorn up to 300,000 into your super, and you don't need to meet other criteria. It's probably a really good way to squash a little bit more in there, but they're reducing that down to 55, which is great, especially for returning and retiring expats. Self-managed super fund residency rules, we were hoping we're going to see an update on that one. However, not at the moment, not too much. 2 to 5 years in terms of the temporary absence test we were waiting on. They're going to push that out, but it said they've just deferred everything regarding self-managed super funds as well as the active members test. So nothing too exciting to push on that one. Moving on to the next slide. Key takeaways for migrants. So I suppose the budget announced the program numbers for the 2022-23 permanent migration program. Planning levels will be increased for the current level of 160,000 to 195,000. So this is great news that they've actually increased it and not reduced it. Often we normally see a bit of moderation there. Right now there is a huge skills shortage in Australia. So we do have a very tight labour market. So the only way to get that is to bring them in. So we definitely need them. Additional funding to accelerate visa processing, resolve visa backlog and raise awareness of opportunities for high-skilled migrants. I know I've got a lot of clients who have a spouse coming over with them and they're sort of in a holding pattern for the whole permanent residency visa and getting that put through. So still a bit of a backlog there, unfortunately. Moving into some tax residency changes on the next slide. So as mentioned, with the residency rule changes, we unfortunately are still in a bit of a holding pattern. We know Jim Chalmers, they are looking at the proposed to update these. However, yes, unfortunately, still in that holding pattern. At the moment, we can still look at the current draft taxation ruling. It is worth noting that, yep, with the ATO recently releasing this draft ruling, in the absence of no changes to the tax residency rules, say in the next 12 months, this will be the tool that they will use to make decisions. Within it, there's about 12 to 13 different case, I suppose, studies that you can use to, I suppose, layer over your own situation. But everyone's situation is different, and it's one thing they just constantly emphasise, that it's on a case-by-case situation, and that's why sometimes we might have to lean on a private ruling when it comes to our own individual circumstances. If we move over to the next slide, I just wanted to do a bit of a refresher on the current old rules from the 1936 Tax Act. So it is a two-tier system, very boring system, but current, I suppose, rules have two tests. The primary test being the common law test, so commonly referred to as the resides test. Very subjective, that test. It has been creating, I suppose, a lot of uncertainty and resulting in high compliance costs for residents or employers. When we look at the secondary tests, they are statutory, so an individual must satisfy one or more of the three tests, so domicile test, 183-day test and the Australian Government official test. Let's just deep dive into them quickly on the next couple of slides. So on to the next slide then. So the primary test, the resides test. So an individual is considered to be an Australian tax resident if the individual resides in Australia according to the ordinary meaning of the word. So a lot of the time this will hinge on physical presence in Australia. To reside in Australia, you need to display behaviour over a period of time that is consistent with residing here, such as that degree of continuity, routine, habit. Therefore, the period of time that you spend in Australia is not by itself decisive on your residency status. It all comes down to your habits and what you're doing whilst you're here. Again, it's causing a lot of confusion with accountants, even with the ATO as well. That's why private rulings are handy. If we look at the secondary tests, onto the next slide, in regards to the statutory tests, so the main three we might have all heard of. So firstly, the domicile test, the person's domicile in Australia unless their permanent place of vote is outside of Australia. So do you maintain a home in Australia that's not rented? One that you can move into straight away, that's left vacant at all times, or are you maintaining a long-term lease agreement overseas somewhere? That's going to be very important when it comes to satisfying the domicile test. The 183-day test, this is very clear and clean. Are we in Australia for more than 183 days in the same financial year? That's it. Lastly, the Australian Super Test. Now, only applying to Australian government officials that are working overseas, that are seconded overseas, so not everyone will fall into that category at all, which means it's mainly the two which will apply or have to apply if you're trying to determine. If we look at the next slide and what this draft ruling is talking about, it still maintains the 6-month rule of thumb for inbound individuals when considering whether they reside in Australia. So that's the 183-day test we just saw. The 2-year rule of thumb for outbound individuals when considering whether they have a permanent place of abode outside Australia. It's mainly referring to, I suppose, what we commonly refer to as the temporary absence rule. So it's very important for, I suppose, self-managed super funds, central managed control, those sort of things, but they are bringing it in as part of this draft piece of legislation. With that in mind, the ATO notes that everyone's decision and residency situation is very different. And as we can see on the slides there, the Harding case, probably one of the most famous residency cases that has come out in recent years and heavily applying to a lot of our attendees today in regards to the Middle East. In light of the Harding decision, the ATO has updated its discussion regarding the application of the permanent place of abode test to include the court's expanded definition of place of abode beyond a bricks and mortar dwelling to a town or country. That's good news in terms of permanent place of abode, rather than just being an apartment or a physical house that we rent. It can extend further, which is good. The Harding case concerned an individual who moved between apartments in a building in Bahrain in a regular pattern while he was based in the Middle East. One of the examples in the draft ruling seeks to illustrate the application of this expanded definition by referring to an individual who moves between apartments and through various countries to take up short-term employment opportunities. The ATO's conclusions in this example is that the individual has not established a permanent place of abode outside of Australia and would be a tax resident. So with this draft sort of legislation that it's just consolidating, there are many different case examples in it, and that's just one case example. If we move on to the next slide, there's also going to be more guidance on the complicated outbound residency cases. These outbound cases typically involve situations where an individual retains some ties to Australia, so e.g., continuing family connections, maintaining assets in Australia as well. The cases have caused more uncertainty for taxpayers due to the fact that the outcomes are dependent on the facts of the particular case. And I mean, I guess when we look at the last few slides that we've just gone over, it really emphasises the reason why we need better residency legislation, to be honest, because everything's a little bit grey and it's on a case by case. If we move on to the next slide, this is just a quick refresher on what the new proposed rules as part of commencing residency. Brett and I, we've talked about the new rules ad nauseum over the last 12, 18 months. So I'm not going to go through them all again because nothing's changed. They're still in their current form. The main concern that we always have is the 45 days because it's such a short period, and a lot of our clients and a lot of expats, they are in countries without a tax treaty. So it immediately puts you at a disadvantage, and that's why we have the petition circulating. Now, if we just look at this flowchart, we only need to satisfy two of these factors and essentially, okay, did we spend 45 days or more in Australia? Okay, yep. Move on to the factors. Right to reside, that's Australian accommodation, Australian family, and Australian economic interests. So very easy to satisfy two of those types of factors. If we just move on to the next slide, Again, the factors are pretty clear. If we just move on to the next slide, the right to reside in Australia, that's an Australian citizen or a permanent resident. If we move on to the next slide, when we focus on Australian accommodation, this one's an interesting one. It's mainly maintaining a main residence that's not rented out, or investment property which remains vacant. Included within the Board of Taxation's report, they even mentioned owning a timeshare that we can move into for say 10 weeks. I'm not sure who's getting around timeshares these days, but the fact that it's included as part of that 120, 103 page Board of Taxation report, they're really making it quite broad. In terms of Australian family ties, if we move on to the next slide, an individual will have an Australian family with their spouse or any children under the age of 18, so a dependent is located in Australia. Spouse will include any partners. This is not expected to include estranged relationships, so ex-wife, those sort of things. A lot of expats send their kids back to Australia to do bordering schools, so I know a lot of my clients, they'll get caught out by that, absolutely. And then the last one is Australian economic connections. So if we move on to the last slide, being economic connections, just tried to summarise this from the Board of Taxation report, but essentially an individual will have a connection where they are employed in Australia, actively participate in carrying on a business, directly or indirectly have interest in Australian assets, and then under the Australian assets, taxable Australian property. So that's an investment property or a main residence that we're renting out. That's definitely a form of taxable Australian property, mainly bricks and mortar type assets. A bank account with an Australian bank receiving cash deposit. Now, they actually didn't give us an amount in the report, and we can't really find anything else which supports a specific figure. I suppose Brett and I are aware of the mind that it's probably going to be in line with maybe the government guarantee of 250,000, but again, we're just reading from the tea leaves right now and we don't have that crystal ball. An interest in a family trust, or I suppose a company as well, receipt of Australian security payments in the preceding income years. So there's definitely a lot there from the economic connections. There are some expats that have connections to family trust very easily because they might have assets in it. So unfortunately, we are still in a holding pattern. However, with that draft ruling that has come out, it does mean that if we don't see any changes to the proposed residency rules in the next 6 to 12 months, you should be using that draft ruling guide that's just been published on the ATO's website as essentially a tool for you to map out your decisions, say in the next 1 to 2 years if nothing else happens. In the meantime, that brings my part to a bit of an end. I'm now going to hand it over to Jeremy to run us through the Australian lending landscape.
Perfect. Thanks, James. Hopefully everyone can hear me loud and clear. Thanks everyone for your time. Just wanted to give a bit of an update around what's been happening in the lending landscape. Obviously, just a little bit of movement for the year 2022. It's been very interesting trying to keep abreast of it all. So just firstly, looking at, there'll be quite a few graphs through my presentation because I think visually it will give us some good idea where things are at. So if you look on the left-hand side here, we've got the RBA cash rate, and as you can see, we started this cycle back in May when we started to start hiking from historical low of 0.10, if you can see that little red line down the bottom, and now we've been on this journey where we currently sit at 2.6%. So over the period of not adjusting rates for over 7 years, we're now sitting at the highest central cash rate in over 10 years. So I guess if you look at that from a real world, we've gone for a little walk along the beach and then all of a sudden we're climbing up a cliff. So obviously there's been a fair bit of shock and people reaching out to me quite often trying to grasp what's happened and trying to understand how that's impacting their mortgage and their repayment, and that's happened over very quickly in a short amount of time. And so just having a look at comparison, what's happening on a global scene, you can really see the US, the Fed, so they're seeing that sort of 3.25, so it just shows you they're a little bit further down the road than we are in terms of this rate hiking cycle. Next slide, thanks Brett. So how did we get here? Well, the start of the year, I thought I'd highlight this from the RBA February meeting where they forecasted inflation to peak around 3.25% this year. And in a short period of time, September CPI readings that came out this week has got a readout 7.3%. So obviously the RBA got this wrong. We're behind the curve on this in terms of trying to keep up with inflation. Interestingly, if you listen to James or myself in the last couple of months, we did anticipate that some of those key drivers from the June CPI inflation would come back, which we have seen, mainly around building costs and fuel. I'll show that in a second, but what's replaced at this quarter is particularly the drivers been around the gas. So you can see there 10.9% for the gas on the CPI readout, and that's particularly alarming. The government came out on budget night this week and forecasted that that's going to go up 50% over the next couple of years. So I think that's a real key issue that the federal government needs to look at to help try and combat how we can get that inflation number down. So you can see in the September numbers, that's a key driver. Next slide, thanks, Brett. So from the September readouts, when I was talking about the building costs have relaxed a little bit in terms of that inflation growth, what we've got here on the left is the lending guidelines or the lending commitments for August. And this is a forward projection of when a bank formally approves a loan. Doesn't necessarily have to get drawn down, but this gives us an indication of the demand for lending in the market. And as you can see there on a yearly percentage, all those categories, particularly in the owner-occupier space, are significantly down on a 12-month basis. So you can see they're purchasing new properties off 30% from 12 months ago. Interestingly, and what I'm seeing is on a sort of more monthly basis, first-home buyers are starting to come back into the market a little bit. So you can see there a little bit of monthly growth there as it's given them an opportunity to come into the market, as we're seeing investors retract a little bit with the change in interest rates. And then on the right-hand side, obviously oil's been flatlining a little bit since it peaked in June, so that we're now starting to get that relief a little bit. And oil came back about 4% for the quarter, so that was good for inflation numbers. Next slide, thanks, Brett. So where are we in terms of the money market? So the big key difference between the Fed that we showed earlier and the RBA here was obviously the RBA meets a little more regularly, but from a housing lending environment in Australia, the Australian household mortgage holders, which is about a third of the population, are a lot more sensitive because the majority of our loans are variable. Historically, it's about 70%. Coming out of the COVID period where we were getting those historically low fixed rates, it actually ended up being about 50-50. Whereas when you look at the US market, the mortgages are locked in 15, 30 years. So the Fed increasing the central cash rate, it's not going to have such an impact on households. But if we look at the average house interest rate in Australia, and you look on the left-hand side there, we've got the variable rates, and the variable rates means if the bank increases their variable rate, that gets passed on to their existing customers. So you can see that orange and that pink line sort of shooting up north in unison, whereas if you look on the right-hand side, fixed loans, so the difference between here is on the new loans, which is that orange line, the cost to take out a new fixed loan since the start of 2022 really shot up and went from 2% up to sort of 4.5%, 5% now, whereas the outstanding loans is now starting to go north slowly, and that's representing the existing borrowers who've locked in a fixed loan, and one of my loans are fixed, and locked in at say 2.5% during that COVID period, and when they start to roll off in the next 18 months, those rates will either revert into a new fixed or into that variable. So you're going to see that real jump from a lot of people, may have a 2.5% mortgage locked in. Once that comes off, well, we're probably looking at sort of 5.5%. So there'll be a huge jump on the repayments. And then on the right-hand side, this just gives an indication of the 3-year maturity on the fixed loans. And that's sort of the most common, if someone does take out a fixed tenure, normally 3 years is the most common. So you can see there that advertised rate for a new 3-year mortgage jumped up from that sort of low 2%. Now it's up to 6%. So huge movement in a short period of time. Next slide, thanks, Brett. And this slide gives a great indication of sort of the demand for loan commitments. And I've got a slide a little bit later showing sort of what happens around the increased interest rates and how that impacts your ability to access credit. But as you can see here, during COVID, you can see the total, which is that red line, which is the culmination of owner-occupied new loans and investors. It started to peak out. But since we're now going to this period of increased interest rates, people's ability to borrow money is reduced, and obviously you're starting to see that demand come off. So particularly it started off earlier on the owner-occupied, and now we're starting to see that attraction in the investor space. For the investor space, similar in 2015, if you remember, APRA came in and introduced all these caps around ADIs and lending around to new borrowers and the investor side under interest only. So when they started to bring those caps, you can see there the ability to access credit around that 2015 period became extremely hard. You could see that demand drop right off. Next slide, thanks, Brett. Great. And James mentioned this earlier around the savings ratio, and this is often referred to by the RBA and the governor when he's been raising interest rates this cycle. But what's really interesting is you can see, if you look at the consumption, which is the orange, it sort of yo-yoed when COVID first came in. We went into lockdown. No one was spending money, so that dropped right down. And then when the shackles released, everyone started spending because they had money in the bank account, and now it starts to sort of normalise around system growth. But interestingly, which I think this is what the RBA will be looking at very, very carefully, is the savings ratio. So coming out of COVID, there's a lot of money in the system from the government, and so our savings ratio shot right up, and you can see that there, it spiked. But what you're seeing now, since rates have been going up, the inflation's been hitting the households in Australia, that savings ratio it's not necessarily where it's sitting, but it's where the trend of it's a very sharp decline. So that's something that the RBA will have to be very mindful of, particularly if from a monetary policy we're not seeing the support there from the federal government around how do we help curb the inflation, and it's left up to the RBA to keep using their mechanism of raising rates. Next slide, thanks, Brett. Okay, so this is a little bit of a snapshot of where the property prices have been over the last 12 months. Interesting that you get a bit of a breakdown between regional and cities, and so on a 12-monthly basis you can see here that the growth has really started to sort of come back to zero. So you can see that it's gone through the peak around that 2021, and now that's starting to give back those gains over that 12-month period. Interestingly, in the month of September, the rate of decrease or it coming back has started to sort of normalise a little bit. So I wonder if we're now going to start to see a bit more of a normalised retraction and not such a sharp retraction as we were seeing over that sort of July, August month. And what you'll also see here is last part there is the breakdown between the regional and the city. So just from the Melbourne city point of view, they're giving back a lot of those gains that came through earlier in this cycle, whereas the regional areas are still experiencing substantial growth. I think part of that is as part of those trends of people still doing the sea change from the cities, taking, the baby boomers selling up the house in the metro and going out as a bit of a sea changer, and that's still firing along some of those regional areas. Next slide, thank you. Okay, but conversely on the other side, we've got a very strong rental market. And so if you look at on a 12-month basis, it's 10% growth across the market. And that's really due to a few factors, obviously incredibly tight dwellings that are available for rent. Obviously, as landlords are feeling that with the interest rate increases, they're passing on a lot of those costs to the tenants. And also with the building costs being so extremely high over the last sort of 12, 18 months, the cost to build a new dwelling has gone out of reach for a lot of Australians. So they're sort of forced to stay within the rental market, and so there's less dwellings available for that pool of renters. And that's pretty consistent between the cities and regional. And I don't think that's going to change in the short term. It's still a very tight market. So what I want to show here was earlier when I was showing you around the retraction in the new loan commitments, a lot of that comes down to perhaps people scared to borrow. Yes, that could be one factor, but it's also the ability to actually access credit. So I've just given two scenarios here, a pretty sort of meat and potato application, two applicants in 2021 and 2022 going for the same loan, live in Sydney with one kid, one credit card, slight bump in their pay. Now, just by virtue of having a higher variable interest rate, so in 2021, that will say 2.5%, by that going up to 5%, In the second scenario, we're stress testing that loan at 8% because there's always a 3% buffer. So the borrowing capacity has gone from, say, 800,000 for a new loan to buy something to live in, down to 700,000. So what that shows is across the market, doesn't matter who you are, your borrowing capacity is off sort of 10 to 15% in a short space of time. So that's going to feed into property prices, and it's going to feed into the ability to get credit. Next slide, thanks, Brett. So what are some of the trends that I can see that will impact the property market, and particularly for expats? Well, returning expats and the immigration policy. So as James touched on earlier, they're really starting to open up the permanent immigration places. The government's increased that to 195,000. We had sort of 500,000 expats returning since the start of COVID. Many of them stayed on for good. And we're now starting to see, although we're not at pre-COVID levels, we're starting to see students come back into the country, which is great, international students. So that's, again, impacting that rental demand, particularly in the metro areas. You're really starting to see a lot of appreciation, those yields around sort of university places or inner city. The core inflation, that's something that's going to keep playing out. If you look at the September readouts, a lot of that is discretionary inflation, which again, there's not really going to be much change around cost of inputs around gas and electricity. That's going to be something over the next 12 months to look out for, which will feed into what I call the renting class. And unfortunately, the people on a fixed income in Australia, their real savings or purchasing power is going backwards. So it means you're going to have less people that can get out of the renting class and get into that first property or something that they can own. So that means that there's going to be more tenants in the market. So if you're looking to be a landlord, there's an opportunity there, unfortunately, or fortunately, depending on how you look at it. Again, sea change is a continuing trend that we're seeing, and that goes back to that regional property growth where people are selling up in the big cities, doing that sea change, buying something outside of the big metro areas, and that's going to feed into the second last point they got there, which is job demand. So as people move out to your Macquarie's, Byron Bay, all these type of areas where they've got aging population that are retiring out there, how do we have hospitals and provide services for that population? And so that's something to think about in terms of, if a new hospital is going to be opened up in a regional area, that could be a fantastic opportunity for investment property that could have rental and capital growth down the line. And finally, still seeing a lot of first-home buyer programs out there. So you're seeing the government helping first-home buyers with a 5% deposit still get into that home. So that's something that's going to continue. There's 30,000 places annually, and that's something that the new government has still committed to as a program going down the line. Next slide, thanks, Brett. And so for the expats on the call, what are some of the opportunities for yourself in terms of mortgages? So obviously you can refinance in this environment, restructure your loan sometimes, maybe from a cash flow point of view, you're paying P&I, that's jumped up, interest only is always an option. Having an offset account, maybe something that's valuable for yourself. Again, purchasing investment property, this is a great opportunity right now if you can access credit. The ability to negotiate with vendors right now is really strong. So there's an opportunity to perhaps get a property that was not available to yourself 12, 18 months ago. Accessing equity to purchase additional property. Now, of course, that does mean if you've owned existing property and you've had that for a number of years, you appreciate the growth over the last couple of years, but then just keep in mind that that's probably going to come down or come off with the market. So if you're trying to access equity, think about that timing and making sure there's sufficient equity there to actually tap into to buy that next property. Using funds for renovations or extensions, maybe that's not such a key theme to think about just with the cost of building materials right now. Construction of duplex or a triplex, so like a small subdivision, build a couple of townhouses, has been incredibly popular with a lot of expats. Obviously if you hold on to those dwellings, increase your yield, having 2 dwellings instead of the 1. And then finally, that option to purchase that forever home down the line. So it might not be an investment property that makes sense from a numbers point of view, but it's a property that that 5, 10 years down, when you do return to Australia, that's where you'll be living. Next slide. And finally, just some opportunities and challenges. So if you're in the Middle East, obviously the ability to use tax-free income from loan servicing, it's incredibly powerful. You know, myself or anyone in Australia paying 30, 40, 45, whatever it is, percent versus zero over there. So that's incredibly powerful from borrowing capacity. The ability to hedge inflation using property, that's just something as a tool to think about. Offset facility, which is a tool again to hedge against rising interest rates. And that's a very strong tool right now for a lot of my clients that are moving money, particularly from where the Middle East is. You've got a strong overseas currency. You're moving that into Australia as cash. You pop in your offset account, you're getting strong FX on that transfer, and you're offsetting that interest rate against Australia. So you're using that as a really good hedge, creating passive income when you head into retirement in Australia. And then obviously last, increasing yields around that rental return that we touched on earlier. So some of the challenges, so obviously APRA and the overall lending environment is starting to tighten up. That's not necessarily specific to expats, but APRA has come in and turned off the tap to some lenders around lending to expats, so there will be challenges. A larger deposit required if you're looking to buy that first property, so 20 to 30%. Restrictions around, you know, the banks want to see normally someone that works as an employee, not necessarily someone that runs their own business. Government and tax changes at state and federal level. I think I had that slide, that little bit there from last time, James. You know, Queensland had it in there as a little thought bubble to bring in that land tax change, and that probably lasted for a few months. They've scrapped that, but that's just a challenge for all of us, not necessarily expats. They think up new ways to tax us, so just something to be mindful of. And then finally, if you're trying to buy a property with a non-citizen spouse, there's just some challenges around that that, you know, I can chat with you offline, but that's just a bit of a challenge. Sometimes people want to buy who doesn't have any sort of visa or tie to Australia whilst you're overseas.
Fantastic. Thanks, Jeremy. I think it's a really good summary of where the lending landscape is right now and what's obviously going on property. As we all know, property is like a religion to most Australians, and it's a very emotive conversation. It's funny how it's gone from this time last year, everyone was talking about what portfolio you're holding and how much you're buying and where you're buying, to now it's a matter of how you're trying to manage that portfolio, mitigate the risks, and prepare for, you know, sort of a bit more uncertainty. You know, that inflation read this week certainly threw the cat amongst the pigeons, and I don't think a lot of people were expecting the rates to rise as much as they did. Righto guys, well I'm going to talk about some economic and market updates right now. I'll try and keep it fresh and easy. We're on the home stretch, so thank you very much for hanging in there. And just a reminder, folks, keep putting the questions in. We can see them coming in right now, so let me blast through this next bit and then we'll open up to the Q&A and let the panel answer your questions. So let's talk about the economy first, and obviously Jeremy and James certainly covered on a lot of this, and I just want to go a bit more detail, you know, with respect to where we are in the landscape, what's driving the Australian economy, and how that's obviously how that relates to what's going on overseas. And the main one I want to show you is the chart on the right there. As you can see, you know, the two main drivers of GDP growth right now is consumption and the government. So that's not necessarily the most enviable position to be in. You know, a lot of businesses have wound back their investments, as we can see there, both in mining investment, non-mining investments. You know, the miners essentially are making hay while the sun shines, and that's pretty much what's kept the Australian economy going. You know, the likes of BHP, Rio, Fortescue, Woodside Petroleum, all those guys and girls, you know, with record commodity prices and more so energy prices, they're not having to spend even as much as they have in the past to generate some amazing results. So thank God the Australia doesn't ride on the sheep's back anymore. It rides on the back of the dump truck, and that is certainly what's keeping things going. When we do look at GDP growth, you know, right now, you know, people have been asking a lot of questions. Are we going to get to this, you know, sort of recessionary period? And the interesting point of that is a technical recession is 2 quarters of consecutive negative change. Doesn't mean that the backside falls out of it. As you can see here, we're just shy of 4% on the GDP growth right now. What it means is we could actually fall by 0.1 and 0.1% respectively over 2 quarters. The Australian economy is still growing very well, and it's interesting to look at the press, which is the picture they're painting, and then the actual facts. You know, there's 2 things that drive markets. whether it's property, equity, or currency markets, sentiments, in fact. At the moment, you've got this tug-of-war between the two, but like with the numbers that I'll show in a second, and obviously Jeremy alluded to in his slide as well too, from a consumer's point of view, we're in the real dichotomy, and people are asking, are we going to go back to 1990s? Where this is different right now is in the 1990s, there was high unemployment, high inflation, high interest rates. So the consumers, that chart on the right there, that number was way down. There was no money being spent. They were trying to rein in inflation, trying to slow things down. Where it's different now is you've actually almost got full employment in that. But anyone who wants a job has got a job, and I'll run through those numbers in a sec. But from a corporate point of view, from a P&L point of view, from a balance sheet point of view, companies both in Australia and overseas are doing very well. And in actual fact, it's the government's the ones that are controlling the debt, and mums and dads that are controlling the debt. Whereas if you go back to the GFC, it's all about the businesses managing their debts. So we're in a very strange scenario right now, and the rule book is not the same to what it was back in the GFC and also to back in the early 90s. When we look at our trading partners around the world, as you can see, China isn't exactly killing it. Their numbers this week did show an improvement, but with them continuing to insist on a zero COVID policy, it is hurting them greatly when it comes to their GDP growth. Obviously, that in turn will affect Australia to that degree. We're very fortunate at the moment that from an energy point of view, most of that is actually exported, much to the Australian government's chagrin at the moment, and not just to China. So LNG especially is going to the four corners of the world right now, and that is certainly offsetting our reliance on the Chinese economy. When we go through and look at the GDP for the Eurozone, US and Japan, we don't tend to look at Japan often because they don't tend to change a great deal, but certainly from a Eurozone and a US zone, their GDP growth rates are a little bit higher than ours at the moment, but with Jerome Powell and obviously the ECB talking about things slowing down, we'll see those numbers start to normalise. Bearing in mind, if we go back and I'll just look at that, show you that previous chart, when we look at the long-term average of GDP growth through even boom times, let's talk about post-GFC, 2011 through to 2019, we're looking at 2.5–3%. We don't need to be killing it. We don't need to be sitting up in the 7s and 8s for both the economy and companies and mums and dads to be profitable. So just bear that in mind. We're not shooting for a high number. We're shooting for a number where it's good solid GDP growth and good solid inflation. We don't want obviously high inflation outstripping GDP growth, because that's when we start to get into the realms of stagflation and those sort of economic concepts. When we go through and look at the inflation rates in Australia, obviously since the data was released by the Australian Bureau of Stats, which is where we get a lot of these charts and a lot of this information, the numbers were, the lights were shot out yesterday, or this week I should say, when we came in at a 32-year high on the inflation numbers. So, when we go through and look at all these different scenarios, where a lot of the central banks around the world were talking about transitory changes and so forth. We haven't seen that to a certain degree, and these problems right now are endemic and baked into the system. So what we're going to start to see out of all of this is really how the central banks are going to rein in that inflation. As Jeremy said, those energy numbers were through the roof at 10% for the last quarter, for the last month. And with 50% increases forecast, it certainly does bring into question the Victorian government's, plans of becoming stateside owners of energy and how they're going to deliver those, goals when it comes from a renewable energy point of view, but also trying to fight the change in the cost of rising energy costs for mums and dads. So when we're going through looking at the US, they're certainly taking that hard and fast approach when it comes to raising rates. The biggest thing we're going to start to see out of all of this is who's going to flinch first. We thought the RBA was the first to flinch when they only raised rates by 25 basis points. That didn't occur. Now that we're going to start to see next Tuesday numbers, Melbourne Cup Day, for any of the punters out there, we're more than likely going to see another 50 basis point rise when it comes to the RBA, and we're going to certainly see a lot of those changes coming through on the other side as well too. Actually, just give me a second here, guys. I'm just realising that there's an old presentation up on the screen here, so I'm just going to try and change that. Okay, it doesn't look like it's coming up, but I'll when we send out the slides, that's also a good housekeeping point too. We'll be sending out the slides with for those who want to read through these numbers and have a look at it. If you do suffer from insomnia, I highly recommend reading these documents at night because it will put you to sleep. So when we go through and look at wage price growth index, this is what Jeremy was referring to before when he's talking about capacity of borrowers and also to the ability for the economy to keep, I guess, thriving. And that's the biggest thing that we talk about with a lot of clients at the end of the day. It's people's capacities to be able to put fuel in the car, pay their mortgage, send their kids to school and so on and so forth. So when we look at these sort of numbers here, as you can see, those numbers are certainly nowhere near as high as what the inflation rates are right now. The biggest thing we talk about for clients is there is a buffer, as Jeremy and both James and Jeremy alluded to before, when it comes to the shock absorbability, the capacity to absorb increases. Right now, Australians are running just over 8% in terms of disposable income. As costs go up, energy costs, mortgage repayments, utility bills, food, that goes up, people will eat into that. So that the big question is how much buffer is there and how long is it going to take for things to settle down? So at the moment, it is okay. But as we've seen by a number of reports that have come out in the last couple of weeks, next year does look like a real crunch year for especially the property market. When the RBA and released a report recently talking about the concerns that they've had with the number of borrowers, bearing in mind there's a lot of people out there who've never been through a rate rise before. So the real question on the wage price index is how quickly they can get wages up and how they can try and get inflation down. So therefore, people's earnings in real dollars, that's a net inflation number, is still balanced out, and people are able to continue their lives. So when we go through and look at this unemployment rate, now I'm just going to refer, these numbers are the previous presentation numbers, so I'm just going to sort of add a little bit ad hoc here. So these numbers now are down here towards the 3s, and the unemployment rate's now down towards the 6. So for all intents and purposes, we are pretty much at record lows when it comes to the unemployment rate. The biggest problem right now is actually for companies trying to increase their headcount, trying to find those people to help them grow, help them build out their respective products and services. So certainly what James was referring to about migrant numbers coming in, that's going to help to plug that gap. That's one of the reasons why they have increased those numbers. But it's going to be, essentially revolve around two different concepts. The first is going to be companies are going to have to increase productivity when it comes to both being innovative, and that is not relying on a headcount, being able to use systems or processes that improve their efficiency. And B, and this is a common topic that everyone's talking about in Australia right now, is productivity. When you've got a capacity employment pool, when there's no more people to bring in, you need people to do more. So the question is how a company is going to encourage that, how the government's going to encourage that. I know the unions right now, they're talking about a real wage when it comes to wage increases and stuff, and the common reply to that by a lot of the business councils is, well, we're happy to pay you more, but we need more productivity out of this. So that's essentially where companies and countries are going to have to struggle that, not just Australia, but overseas as well too. So we look at bond yields. Bond yields are now further up towards the 3% mark. So you can ignore the headline there, and as I said, I'll be sending out a copy of the presentation which will have the updated numbers, so I do apologise for that. The biggest thing is we all know rates are not on hold anymore. Rates are definitely on the way up. These numbers here are back from May this year, just before the RBA started raising rates. So as Jeremy showed before, those statements that the RBA made late last year and early this year, there certainly is egg on their face. Headwinds for the economy. Obviously escalating conflict in the Ukraine, interest rate increases, lack of wage inflation. Those are the big ones. As long as people's buffer maintains some degree of solvency, obviously right now we have seen a number of numbers coming out regarding mortgage stress and the percentage of people involved in that, but right now what's helping people out is that those savings buffers that they built up through COVID. So from our point of view, when we look at these scenarios, what it really comes back to is how long are we going to go through the rate rising cycle? Because to me, the longer it goes on for, the more that buffer that we hit into, then we start to get into issues. The big question is going to be is when's the RBA going to hit the brakes? I can't see them extending this much longer. I think, by second quarter of next year, I think we should start to see the last of those rate rises, but it does mean we might have the odd 25 basis point increase here and there as the RBA goes from using 2 feet on the brakes to 1 foot just tapping it from time to time. So running through the Australian dollar, look, the big thing with the Australian dollar right now is it's a risk asset. So the reason we have seen the Australian dollar weak of late is because everything's been weak. This chart here, it's a little bit old. It's about a month old. So what we've actually seen in this period of time is both the pound and the euro have actually caught back up to the Australian dollar in terms of the last 12 months. Obviously, the UK has got its issues. It seems to be, dealing with that with the new Prime Minister and new Chancellor. The biggest thing for us right now is the Australian dollar going to increase? And to me, it comes down to 3 things. First of all is interest rates. When we saw that inflation number come out this week, the first thing that happened was the Australian dollar went from 63 cents to 65 cents. Second, it was commodity prices. Commodity prices stabilise, energy prices too. Then as long as they're supported, then that'll keep support in for the Australian dollar. And last of all, it's sentiment in the market. When investors do get nervous, they hit reset like playing an Xbox or a PS4, and they'll go back to US dollars as a safe haven. At the moment, things are starting to normalise out over the last couple of weeks, and that's why we have seen the pound, the euro, the Australian dollar all starting to appreciate against the US dollar. But there's a lot of spinning plates that have to be maintained in order for that strength to continue. If we do see the RBA start to settle down on the rate rises, which I don't think we will, but if we do, and commodity prices soften, then there's a very good chance that you might actually see the Australian dollar with a 5 in front of it. I give that probably a 20% chance at the moment, but at the end of the day, and like James and I have talked about in our podcasts, ad nauseum, I guess is the best way to describe it. And if you don't follow our podcast, make sure you have a look at the Expat Chat podcast on Apple and Spotify. And also James and Jeremy run the Expat Mortgage podcast on both Apple and Spotify as well too. But as we talk about on our podcast, if you do like the currency, don't try and be too clever. To me, if you like the rate transfer, don't try and wait for that extra 5 cents or 0.5 cents or 0.1 of a cent. Like we've seen for those folks, it was at 61.70 only a couple of weeks ago. So, and I'm sure there's people there going, I'm just going to wait for a hit into the 5s. No, it's now back up to 65. That opportunity may have been lost, and we don't know how long for. So when it comes to currency, if you do like the price, just take it. When we look at the trade-weighted index, and this is essentially the Australian dollar as a purchasing power across a basket of currencies, we've actually held up pretty well. We haven't actually really changed since 2015. Yes, against the US dollar, it's weakened. Against the euro and the pound, it's strengthened. So it's, when you look at that average figure across the board, from an Australian's point of view, things are okay from a economic point of view, which is the most important part. It's when we see that degrading number getting down into the 60s, that's when we do start to get concerned, because obviously then it becomes a very expensive country to run when we're so reliant on imports. So on the Australian equity markets, and once again, on most of these numbers will be, okay, we're okay for some of these, so which is good. So what we've done here is we've compared the Australian market with both the Dow Jones, the Nasdaq, and the S&P 500. And as you can see there, we've been actually holding up pretty well. We have seen turns of late, and with these turns, once again, that's a confidence piece. There's a tug-of-war between sentiment and fact. At the end of the day, US companies are going through their reporting season. Australian companies are going through their AGM season. So we are getting guidance out of companies. And surprise, surprise, the 4 horsemen of the apocalypse aren't coming around the corner unless you obviously run companies like Optus or Medicare, or Medibank Private, I should say, because those companies are on a hiding to nothing at the moment with how they've handled these issues. When it comes to coming through and looking at investments going forward, you need to be baking into your investment strategy higher interest rates. They are here. We're not going to get back to the record lows what we were back in the COVID period. They are here now, even just working on a normalised level of 3%, which is the RBA rulebook's sort of safe space where they like to be between 2.5 and 3. You need to be looking at companies and countries and sectors that operate either well or successfully with interest rates at those levels. So looking at companies' gearing levels, just no different to how a bank assesses an individual for a loan. It's those key issues that you need to sort of take into account, because we are in this cycle for longer than I think a lot of people do believe. And we go through and looking at the on a log scale when it comes to how the respective economies are going. Certainly the US has been driven massively over the last couple of years by through COVID. It's the tech sector. There's, when you're investing, there's two cycles you can look at. There's value and growth. So a value investment is something that's been in existence for 10, 20, 30 years, 50 years, 100 years. It's got a long-term balance sheet. Companies like GE, Johnson & Johnson, any of those sort of industrial companies, especially consumer staples, that's a value play. When you look at growth plays, they're the companies that rely on funding cycles and they don't necessarily make a buck. And if you look at something like Tesla, for example, that doesn't make a profit. They actually rely on tax credits to pay their bills. So to me, with rising interest rates going up, the funding cycle for those growth companies is broken. You don't want to be a startup at the moment because you're going to find it very difficult raising cash. There's that cost-benefit equation between you deploying your money into a startup or getting a guaranteed 3.5% return from a government bond. Whereas before, when those government bonds were at sort of 0.1%, you had to try something. So that's why that cycle has definitely changed, and it's changed certainly for the next short to medium term, that's for sure. When we look at the emerging markets, we certainly like the emerging markets. To us, the emerging markets are areas you can go through and cherry pick. When you even go through and look at investment opportunities like in UK or Europe, the euro's at a 22-year low to the US dollar. Do you think that the euro is going to trade at that level for the next 10 years? No. There'll be a normalizing effect that goes on in those currency markets. And when you go through and look at sectors and companies in those markets, combined with that currency uplift as people go risk on and they start to come out of US dollars into these foreign currencies, that's when clients will be able to create some alpha, and that's when you'll certainly be able to get some returns. As we see here, there's a lot of areas. Europe's been probably the hardest hit, and obviously, surprise, surprise, Ukraine is the main catalyst for that. But as we start to see the Europe get through the winter, which is obviously the big concern with respect to energy prices, things will start to become more known. There'll be more benefit of hindsight with respect to what's going on in those respective economies. And obviously, fingers crossed, we come to some sort of resolution with respect to Ukraine, because, that's not doing anyone any favours, especially Ukrainians. The other question we sort of talk to clients a lot about is, do you invest in these periods? It's a very good question. And, we work with a lot of providers out there from a research point of view, Morningstar, Vanguard, when it comes to us helping us advise clients. And this is a chart that Vanguard calculated, which I think is a great chart. And essentially what it is those grayed out periods are recession periods that, we've gone through either a short or a long-term recession. And those the line chart actually reflects the S&P index. So as you can see there, if you just decided to buy through every single recession going back to 1973, you would have done very well. And the reason being is it's counterintuitive from a personal point of view on how to invest. There's a lot of times you'll sit there and go, oh, it just doesn't feel right. That's actually the time. Now, it doesn't mean you go out and buy any stock. There might be a reason why that stock's trading at 10 cents a share. So you still need to be investing in quality. And that's why I said before, you need to, when you look at your investment options, you need to be baking in what the next 2, 3, 5 years looks like. But as you can see there, if you go through and look at quality, if you stick to even just the big end of the large and the mega cap sort of companies, you are going to get over a period of time, good returns. It's just a matter of it's trying to take that emotion out of it. It's very easy to paper trade and use Excel spreadsheets and stuff. The hardest thing to do is actually hit that buy button, especially when we're going through periods right now when there's uncertainty. But as we know, in these markets, in these environments, the chance of losing all your money by investing in the S&P 500, you have to have 500 of the top 100 companies, top 500 companies in the United States go bust tomorrow. So that just puts it in perspective in terms of if that does happen, then I don't think you'd actually be worried about your money. I think we'll all be living in caves, eating baked beans and trying to hunt for our kill if that sort of scenario pans out. The other one too, which we do like, and this was actually done with both Morningstar and Vanguard using the S&P All Ordinaries Index, and it just talks about if you put $10,000 into the market back in 1980, and then the different scenarios that pay out based on those ongoing contributions. And James and I do talk about this a lot in our podcast about dollar cost averaging, whether it's investing or transferring cash using foreign exchange. Yeah, and the numbers don't lie. You know, if you essentially put $10,000 into the market in 1980, as of 2022, that'd be worth $750,000 now. However, if you put $10,000 in and put $250 a month towards that, it'd be currently worth $2.46 million. And if you double down on that and put 500, it'd be currently worth 4.15 million. You know, the biggest conversation we have with expats all the time is, you know, most expats, their time overseas is finite. The incredible opportunity you have in terms of investing in non-taxable assets, e.g. assets on account domiciled in Australia, that you can invest in that doesn't accrue a capital gains tax liability with the ATO, and using this type of approach. Obviously, we're not going to look at from 1980 to 2022, but even just if your time overseas is a 2 to 5 to 10 year period, that dollar cost averaging, especially buying through these dips and buying through these difficult times, will certainly put you in good stead. And the biggest thing is having something to show for your time back in Australia when you do return. One of the things we always talk about is it's always difficult. Do I or not? You know, and do I want to go on a holiday, or, you know, do I want to have that cash deployed? If you do set up the ability to structure your finances and structure your investments so it's disciplined, if you get paid on the 26th or the 28th of every month, the money goes in. You don't even think about it. By doing that, you are taking emotion out of that. And that chart before where I showed if you were buying through those dips, that's when you'll actually take advantage of that opportunity. And, you know, obviously this is another one that both Vanguard did as well too. And, you know, people are always trying to be, you know, clever when it comes to picking the tops and picking the bottoms. But as we can see there, if you go back to 1992, and they did this analysis where if you put money in 1992 and you were exactly right in terms of picking the tops and the bottoms every single time and every single fluctuation, you can see there between just doing a standard base portfolio, which is 60% growth assets, 40% income, by doing that, you know, you're not that far off from being right 100% of the time, which no one is. No one is. You know, if someone was, they'd be sitting on a very large yacht in the Maldives right now. So don't try and pick the bottoms and pick the tops. You know, we don't, you know when those events occur until after the fact. So by buying disciplined on the way through, what it means is it really comes back to ensuring that you are building out on your investments and you're doing it in a very practical way. So right, guys, well, let's throw it open to a bit of Q&A now, and there's a lot of questions that came through, which I'm just about to bring up on the screen here. And there's a couple emailed through as well too, so I'm just trying to find those as well. So, okay, where are we here? Questions. The questions one's disappeared. I'm not sure where that's gone. Okay. Oh, here we go. It's hiding down the bottom here. Okay. So first question from Zachary, who's up in Sweden. G'day, Zachary. Can you please touch on the impact tax treaties still have, for example, taking precedent over domestic law? Have you had any recent practical examples? James, do you want to cover off on that answer, mate?
Yeah, that's a good question. And I suppose it's drilling down specifically on your country of residence. And whilst there are a lot of tax treaties, a lot of countries, all the tax treaties are a little bit different. I think probably the tiebreaker test around residency rules is probably the one that a lot of expats will need to drill down on. Most of the time, and in its current form, the new proposed residency rules, as they state, that 45-day factor test, in the event there will be a treaty interaction as part of the proposal. It means that a lot of expats will be able to technically come back to Australia for more than 45 days because they ordinarily would still remain a tax resident of that other country, whether it's Singapore, the US or Swiss. So with that in mind, we know that a lot of tiebreaker tests will take precedent over that 45-day factor test. Probably that's what the biggest issue is with the current residency rules as they're proposed in that Board of Taxation report. There are a lot of expats residing in countries. Middle East is the easiest example to give. There's a lot of countries covered under GCC and none of them have tax treaties. Plenty of information exchange agreements wanting to know where your assets are and your savings, but no DTAs in place to cover you in the event you're back for, say, more than 45 days. So I think there's still a lot more that will come out from ideally the Board of Taxation and the government surrounding the current DTAs, because a lot of our DTAs are very old as well and don't include sort of new things like Australian superannuation in the US. Theirs was formed back in the 80s, early 80s. Superannuation wasn't even a thing. So there's a lot of DTAs that need significant updating as well.
Yeah, and just also too, as a bit of an update, yesterday the UAE Cabinet released more information from a tax point of view on qualifying as a UAE tax resident. So you can see the framework coming in now to different countries with these, sharing agreements like Common Reporting Standard and how that's getting interlaced. The onus is going to be more solidified in terms of proving your tax residency in that country, and then how it interlaces with that double taxation agreement as well too. So I think, definitely at the end of the day, it comes back to it comes down to the individual DTA. Obviously with Zachary, it comes back to Sweden and how that works together. Rob's sent in a question from Switzerland. G'day, Rob. Where are 190,000 immigrants going to live? Capacity looks like it's going backwards. Will they direct that traffic to certain cities or regions? James or Jeremy, do you guys want to cover off on that?
I might defer to Jeremy, actually.
Well, that's a very good question. I know particularly in some of the metro areas, during COVID, a lot of people left the inner city apartments. There was a lot of vacancies there, so I guess they could move into there. But I do know that they're trying to get them out into the regional areas. There was actually an article out that there was a job for a doctor out in rural New South Wales, and they couldn't get the place filled. It was free rent and it was $500,000 wage. So there is a bit of a challenge to get people outside the city still.
Yeah, I think also
too, haven't they changed the rules as well when it comes to skilled visas, that you can't go to one of the three major cities? It has to be Adelaide or Perth or Toowoomba, or I don't know. They actually stipulated based on your skill. I think they are actually directing people to not the major or the top cities anyway.
Yeah, and I also reckon a lot of growth corridors will start to fill in probably over the next 5, 10, 15 years. A good example of a growth corridor is, I'm lucky enough to be on the Gold Coast, and Brisbane's only an hour away. So anything between there is considered a growth corridor, and it's slowly filling in. So those areas, I would say, as where most of those migrants will probably fill in the gaps.
Fantastic. And Tanya's left a question, and does the famous capital gains expat housing affect, and does the famous capital gains expat housing affect things? I think she might be referring to main residence exemption, possibly. Not sure there. So, I think that change has come and gone. The people who were going to navigate that space, it all happened. Yep, she said yes. Okay, great. Thanks, Tanya. That change occurred pre-30 June 2020, didn't it? So all those who were going to sell and so-called make property cheaper, which is what the actual legislation was called, Housing Affordability Bill, it didn't really have much effect at all.
No, not
okay.
at all.
On to Andrew. Is the Queensland National Land Tax grab now officially dead? James?
Yep.
Well, actually, Jeremy, go for it. Yep.
We both talk about it, don't we, Jeremy, on our podcast? But in its current form, what was proposed, it is dead. But as we know, state governments always find another way to generate some more revenue. I think the facts we've read out in the past, I think Queensland, and Jeremy might be able to correct me, I think 49% of Queensland, or maybe it was New South Wales, state revenue comes from property transactions. So any way that they can milk that a bit further, why wouldn't they? So the fact that it got thrown out, it's good news, absolutely. But I always think that it just means we're only 12 months away from another new creative proposal from them.
No, the Greens, didn't the Greens in Queensland propose the 5% vacancy tax, which is even higher again than Melbourne's one? And essentially it was if your property is vacant, you'll pay a 5% fee based on the improved capital value, not the unimproved capital value. So that hasn't been legislated. They've tabled it. So, yeah, watch that space. It doesn't seem to get very dull and boring from a legislative point of view coming out of Queensland these days.
But interestingly, on the other side, New South Wales, just to sort of fly the flag for down south, if you do hold property, the land tax threshold has gone up significantly this year. I think it's about 920,000, so quite a bump. So that will mean that if you've got significant land holdings in New South Wales, then you'll get a bit of relief on your land tax.
Yeah, and so it should. I mean, the average price has risen, so should too the threshold. Rightio, and Tanya's also talked about timings of the anticipated fall or squeeze, and I'm assuming she's talking about the property market there. Look, if you look at all the economists around Australia, they're all in agreement, including the RBA finally, with those leaked notes. To me, these things take time to build. Since 2018, which is when the Banking Royal Commission happened, when you look at banks' remediation programs and those sort of things, in the past it was 90 days of defaults and bang, there's a sign at the front. If there are people going through severe mortgage stress, I think it's, Jeremy, you might know more about this, but an article I read, a report I read said it takes 12 months now to go through the respective bank departments before they finally call it quits and decide to take the house from you. So yeah, to me, it's the property market doesn't react like the equity market. It does take time to bake it in, and you only know based on property sales. If no one's selling, then you don't actually know what the price is when it comes to what that new value is for that type of asset. So as more properties get sold, certainly, like Jeremy said, you're going to see different numbers coming out of both the capital cities and the major cities. So, as we were consistent say on the webinars, averages are dangerous. So don't look at just the total market. You need to look at your specific city or region and see what they're doing, because Sydney might be down 15% in 12 months' time, but Brisbane might be down too.
Yeah, exactly.
Okay, Peter. G'day from Peter in Abu Dhabi. Thank you for the guys for today. General question, should we be putting cash in the bank with interest rates on the rise or throwing more cash into the stock market? Okay, it's a good one. Jeremy or James or both?
Well, I mean, I know personally from the cash, when we always go through a tightening cycle, banks always take forever to pass on a good savings rate. Even though you might see term deposits starting to get a little bit more attractive, they're still not there in terms of the mortgage rates. I think most traditional savings banks will still be giving you maybe 1 or 2%, maybe that bonus saver. So if you're only getting 2% and you look at a typical frank dividend yield on a ASX blue chip share, it's usually ranging between 3 to 5%. You're still getting an attractive yield on your dividends. Always depends on what kind of investor you are, the risk, how long it's going to be invested. There's a lot of things that go into that, whether that's the right decision, buying a share over a term deposit. So definitely seek out advice around that. But I haven't seen good savings rates come through just yet. Term deposits are starting to get there depending on where you're looking at them. But it's always the case where mortgage rate, we feel it straight away. Savings rates, there's always a bit of a delay there.
I mean, all I would say is we had the inflation readout 7.3. You're not going to get that in the bank. So if you pop in a bank, you're going to go back in real terms.
Yeah. Okay. No, I agree with all that. At the end of the day, it's the cost of equity, isn't it? What's it costing you in inflation in terms of purchasing power versus the returns that you can get on the money? Okay, next question is Bron Burns. I think she's talking about what kind of fund is that? We got stung by managed pension funds. Vanguard question mark. Yeah, look, it's a very good question, Bron. Essentially, what we're referring to there is actually market returns. We're not actually referring to specific managed funds or particular investments. It's just if you invested in the S&P 500 at this return, that's what the returns you should get. Sorry to hear that you got stung by managed pension funds. Yeah, and then there's a lot of not dodgy, but less than professional businesses out there that providing less than adequate returns. So all I encourage you is certainly reach out to us. We can have a chat because there's a lot of options out there and a lot of ethical businesses and a lot of companies providing very good returns. So we're not a fan of managed funds personally. I think they're an old archaic financial product. To us, we're more fans of direct equities and ETFs in that model. The question from Sharon, not a question. Oh, okay, there we go. But just a thanks for a fantastic presentation. Thanks, Sharon. Appreciate that. Okay, question for Nada. Is it better to keep money in the bank and wait until the right property comes in at a cheaper price? Gentlemen, I'll throw it open to you.
Good question. How long's a piece of string, though? You could be waiting a very long time for what you think is the right emotional investment decision. If you're purely only looking at property, I think Jeremy's got a good saying, and I'll hand over to him to finish that. If you know you're not going to be buying for 5+ years and you're just building up savings, then 5+ years is an attractive time to be investing the money. If you're an expat, well, there's certainly tax advantages with that. You're an expat, so you're not paying any capital gains tax on direct shares, ETFs, managed funds. If you're in the US and you're listening, you'd be careful of PFIX. If you're in the US and you're listening, why you're awake. But with that in mind, it depends on how long you'd be waiting there. I think property's a different one. If you're really trying to get that property under your belt, say in the next 12 months or the next 24 months, you're not going to really be able to pick the bottom or anything like that. It's about just getting in the market rather than trying to time that market. See if Jeremy's got some feedback as well.
Yeah, I'd just say when you say cash, if you've got a substantial deposit and you're still going to be relying on some form of borrowings, as I was saying in the presentation, just keep in mind that it will work in correlation as everyone's credit ability to access and borrow reduces. That will impact property prices. So if you're waiting and property prices going down, your borrowing capacity is also going down. So it's not like you're going to get a free hit. But if you've got sitting in cash completely, you can definitely pick the eyes out of the market a bit because you're in a great position. You're not constrained by your borrowing capacity. You could wait for that opportunity to come across. I would keep in mind there will be that inflection point with the rents tightening up. 10% growth across Australia in the yields. There's some markets where you can get 6-7% on your rent. That's going to start to tighten up the property price at some stage. So when that's anyone's guess. I think if someone can tell you that, they're probably telling porkies. No one actually knows when that point will be. But I think if picking a time that's suitable for yourself is.
I think the asset, if the asset price stacks up, it doesn't really matter what the price does after the fact when it comes to what you're using it for. If it's going to be your forever home, you're returning to Australia in the next 2 years and you see a house at the price you like and you are going to move back into that property, then you might roll the dice. If you are looking from a pure economic Excel spreadsheet point of view, is there further to go? Yeah, more than likely, depending on which city you're looking at, which region you're looking at. So I think it really comes back to you can't just throw a blanket over the top of the property sector and say X because you'll get 1,000 different Y answers when it comes to what that looks like. Question from Tanya: how long is it to be a resident? Is there a precedent? James, do you want to run through that?
It's actually a very difficult question to answer. How long it takes to be a resident. There's many things that sort of tie into that. If you're looking at the current rules, you're looking at the resides test. It's based on different habits, your connections to Australia, whether you've just signed up for a 1-year lease, whether you moved into your house, even down to things like your internet bills and signing up for electricity. So there's no rule of law right now on what it takes to resume your residency. If you're speaking to a lot of accountants, generally speaking, they might just start with 183 days because it's built into the current old rules. And that might be enough. Just be careful though. I'm just going to caution you because a lot of expats, when they introduced the change in the MRE, the main residence exemption, they wanted to bounce back to Australia for a couple of months, try and sell the asset, pay, it not be taxable, and then bounce over again. So if you're doing something to try and outsmart the ATO, they've got no issues with leaning on Part 4A, the anti-avoidance rule, auditing you for the last 4 years and making a determination on whether you did it just to avoid some sort of taxation. There is no rule which governs how long you need to be back in Australia. It's all these different factors, physical presence, that also tie into it. So wouldn't be able to give you a direct answer, I'm sure. Yeah, it's more personal based on your situation.
It's virtually the rules that we rely on as expats to become a non-resident in reverse, isn't it? So, the resides test, the domicile test, the 183-day test, just backwards. So when you reside in Australia, tick. When you pass through that 183-day test, tick. Do your behaviours match that of an Australian resident? Are you buying cars? Are the kids going to school? Do you have a rent? So that's all that sort of stuff in reverse. And in terms of timing, everyone's timing will be different when it comes to meeting those requirements. Okay, on to Tanya question, podcast. Oh yes, okay, so we've got 2 podcasts on Apple and Spotify. The first one is called Expat Chat, and that is myself and James talking about everything to do with tax, financial advice, markets, investing, all those sort of bits, pretty much the whole gamut of managing your money as a non-resident investor. And then the second one we've got is the Expat Mortgage podcast, which is James and Jeremy. And normally we have episodes coming out every week on this, different topics every week, really try to give a lot of value when it comes to just educating people. The three of us are all about educating. It really comes back to helping you guys and girls make informed decisions at the end of the day and making the most of your time away. So all that information is free, to download. So Expat Chat podcast, Expat Mortgage podcast, subscribe. And if you do like it, we'd love to get some reviews and a bit of feedback as well too. And a question from Rachel, to build on savings versus stocks, pay off the mortgage or buy shares? I think I'll have a crack and then I'll hand it over to you guys. First of all, it comes back to a couple of things. We don't like clients to generate positive cash flow on their properties. So neutral or slightly negative is preferred, because as soon as you do pop up into that positive cash flow nature, you are paying 32.5% tax on that first dollar. So the general reaction of a lot of expats is to pay down the debt. In actual fact, we like to sort of triage cash flows when it comes to managing that cash flow while a non-resident. So while you're a non-resident, pay off the required amount on the mortgage, divert surplus cash flows towards non-taxable assets, and then when you do land back in Australia and you take that resident returning card, then you sell those down capital gains tax-free and pay off the debt. So you've got to the same result, but in a more tax optimized sort of way. And that really comes back to a personal decision. Some people just don't want to get in stocks. And in that case, you can put money in the offset or pay down the debt. Just be mindful of the fact that you more than likely will push your cash flows into a positive cash flow when it comes to your property. And if that's the case, then there are strategies that we employ with clients, like concessional contributions to super, to try and bring down the tax rates. You can't extinguish it, but you can reduce it or mitigate it to a certain degree. So it really comes back to, Rachel, in your situation, what matters most to you. Some people just want an unencumbered property, and that is okay. But as long as you know the ramifications behind that, because a lot of people do leave Australia, they get overseas, and the first thing they do, they've got extra cash flow, they pay down the debt, and the next thing you know, they're getting all these tax bills. So it's always important to have your goals and objectives down the track of what you want to achieve, and then have those 3 different paths you can choose in terms of paying some of the debt, putting some in stocks, paying all the debt off, or just putting it all in stocks for the time being, and then paying down the debt when you get home. So it really comes back to what suits. There's no, I'm not going to say there's no right or wrong way. I know from a Excel spreadsheet there's a right way to do it, but it comes back to mapping to your personal objectives and goals as well too. And question from Zachary, a bit off topic. Have you heard of anything on the Vanguard approval for their Australian super fund? Actually, I haven't looked at this, so if you guys don't mind, I'll quickly touch on this. The first problem you're going to have, Zachary, is Vanguard are completely risk averse in terms of dealing with expats. So if you are a tax resident of Australia and you put money directly into Vanguard and go to change the address to overseas, they will kick you out. And more than likely this is going to happen with their super funds. So I don't think you'll find that when this does get up and running, it's going to be too sympathetic towards expats. In saying that, there are other super funds that we recommend to clients that do enable you to buy Vanguard ETFs inside of their platforms. So it doesn't mean you can't not go down the Vanguard route, but in terms of using Vanguard as the super provider, at the moment, I don't like your chances.
Great.
And with Rachel's reply again. G'day, Rachel, again. Thanks with always fear paying into super indicates an intention of return. No, it doesn't. You know, super's agnostic when it comes to residency rules. Certainly when it comes to mapping to your behaviours. You know, if you're a rock solid dinky-die non-resident for tax purposes and you've got all the gear to prove that you're a non-resident, contributing to super is okay. And in actual fact, in the Harding case that James referred to earlier in the High Court, they did say that it is plausible and probable for people who are Australian citizens to invest money back into investment and super accounts because it is a highly regulated jurisdiction with high corporate governance and low sovereignty risk. So, you know, certainly from a do you or don't you, it is an expat myth. Certainly here in the sandpit in the Middle East region, a lot of the offshore IFAs who like to think themselves as competitors to us that, you know, that can't hold a candle to the work we do, they will tell you that if you do contribute to super, you will be considered a tax resident. And the answer is unequivocally no. Yep. Okay, any other questions there, guys? We can wrap it up shortly, but last chance to have your questions. I will show actually, if you do want to have a chat with us, feel free to jump onto our website, atlaswealth.com, do your homework, learn more about us. You can read more about articles that we all produce. You can subscribe to those articles, newsletters and everything. If you do want to seek personal advice from either Jeremy, James or myself, then just jump on there, hit the contact page, fill in your details and we'll reach out to you. So without further ado, gentlemen, I think we leave these good folks to get on with their days. And thank you once again for your time, Jeremy, James, and also the audience.
Thank you.
Thank you, guys.